Good morning. Thank you for joining today's daily webinar where we discuss your daily questions here on the live chat. We go over certain topics. Today's topic is the $70,000 Roth IRA strategy, specifically how to use a mega backdoor Roth self-directed 401k to save $70,000 in your Roth IRA. As always, you can ask your questions here in the live chat. We'll be back again today at 1 p.m. Pacific time for more information and to answer more questions. Let's get started here. Let me share my screen. Before we start talking about the steps involved in utilizing the Mega Backdoor Roth Solo 401k to make an annual $70,000 contribution and subsequently convert it to a Roth IRA, let's talk about the contribution rules. We're going to concentrate on tax year 2025, even though you still have time to both open a solo 401k plan here in 2025 so that you can make contributions for tax year 2024. You have until your business tax return due date plus timely filed extension here in 2025 to make 2024 contributions, specifically voluntary after-tax solo 401k contributions, so that you can then convert those over to a Roth IRA or even to the Roth Solo 401k plan. The contribution limit for tax year 2025 is $70,000. This is the overall limit. So that's the overall contribution limit for a solo 401k plan. The $70,000 can all be applied to the voluntary after-tax solo 401k bucket and then subsequently converted to the Roth IRA. So it would flow into this bucket right here, the voluntary after-tax bucket. And then you can convert it to the Roth Solo 401k or the Roth IRA. So another item regarding the $70,000 overall contribution limit, this means that in order to contribute $70,000 as a mega backdoor Roth Solo 401k contribution for tax year 2025, you're going to have to report enough net self-employment income to be able to contribute the $70,000 figure, which is a dollar for dollar calculation. For instance, if your self-employed business is taxed as an S corporation, you simply need to pay yourself $70,000 of W-2 wages for tax year 2025, and then you would make that contribution to the voluntary after-tax solo 401k bucket, and then it would get converted to the Roth IRA, and that's how you would end up with $70,000 in Roth IRA funds for the year. Keep in mind that you can't contribute more than you make. So if you don't make enough net self-employment income, then you're not going to be able to contribute the full $70,000 as a voluntary after-tax contribution for tax year 2025. Let's take a look at another figure here, another slide, I should say. And before we do that, let's take a look at some live questions here on the live chat. Looks like we got a question here from Luis, some type of over contribution question. I over contributed to my Roth 401k for 2024, and I just pulled out the over contributed amount. as well as the earnings. I need to pay taxes on the earnings for 2025. What form do I complete on my solo 401k website to get a 1099-R? The partial Roth solo 401k distribution form only asks for the total amount distributed and doesn't specifically reason for distribution. So if I understand correctly, you made a Roth solo 401k contribution. It was not a voluntary after-tax contribution. It was not a employer contribution either, but it was rather a Roth employee solo 401k contribution. So when you make an over contribution on the employee side, you have until April 15 to remove the excess contribution amount plus the earnings. And you would actually work with your CPA and issue in that Form 1099-R. We don't issue Form 1099-Rs for excess contributions. We issue a Form 1099-R for conversions and normal distributions. When it comes to issuing 1099-Rs for excess contributions, that's something that you got to handle with your CPA. So that's probably why you don't see a form on our website. Let me share a link from our website that you can share with your CPA when you go to remove that excess contribution. And on that page here, we clearly state that you need to work with your CPA in removing those excess contributions and reporting them as well. Well, here's the link to that page. Take a look at that. Okay, let's take a look at another question here. I'm going to convert pre-tax solo 401k funds to Roth. Should I convert them to the Roth 401k or to a Roth IRA? Am I eligible to do either? And what are the differences besides the different rules for Roth IRA and Roth 401k, which I'm already aware? So, in order to convert pre-tax solo 401k funds to a Roth IRA, you have to meet a triggering event. And those rules are different than today's topic that we're discussing, which is how to do a voluntary after-tax solo 401k contribution and then convert that to the Roth IRA. Your question deals with pre-tax funds. Those have different IRS rules, and they work as follows. In order to convert a pre-tax solo 401k contribution, you either have to be age 59 and a half, or you have to be no longer self-employed, in which case the solo 401k would have to be terminated. Another option is if you have other pre-tax solo 401k funds in the plan. For example, if you transferred an IRA or a former employer plan previously to the solo 401k plan, those specific funds can be converted to the Roth IRA. However, if it's a contribution, if it's a pre-tax solo 401k contribution, the rules I mentioned earlier apply, which are either you're age 59 and a half or older, or no longer self-employed. Those are the triggering events you have to meet in order to convert pre-tax solo 401k employee contributions to a Roth solo 401k. So in short, there are different rules that apply for each source of funds. And then the regulations under Secure Act 2.0 even muddied up the waters more, because now you can make employer Roth solo 401k contributions, and those have to stay in the plan as well for a certain amount of time, unless you meet the triggering events I just mentioned. So in your case, if you are not age 59 and a half, your only option is to convert it to the Roth solo 401k plan, not to a Roth IRA. That is the pre-tax solo 401k contribution. Okay, let's see here. All right, looks like we have another question here. Can you walk me through the process of investing in a private investment through my solo 401k Roth custodied at Schwab? What happens when the money leaves? Does Schwab actually show the investment online, or does the money just leave the Roth IRA and there is no asset recorded? Thank you. So keep in mind that with the solo 401k plan, you are the trustee of the plan, which means that as the trustee of the plan, you are the one that safe keeps the private investment paperwork. You can safe keep the private investment paperwork in your home office, or you can hold it in a safety deposit box. It's really up to you. Neither Schwab nor my solo 401k financial will hold on to that investment paperwork. So when let me share the procedure of having Schwab send the money out for that private investment transaction. Before we go to that specific procedure, let's share the private investment company procedure here. So you're going to want to take a look at this private investment procedure here, which has rules regarding making a private investment using your self-directed solo 401k plan. There's a good infographic there. There's even a video there that talks about the investment. It talks about the different paperwork that applies when making a private investment. It's got a lot of good FAQs as well. So take a look at that. As far as placing the investment, if you use Schwab's brokerage account for the solo 401k that we provide to hold the funds, which Schwab refers to as a company retirement brokerage account, then I'm going to share the procedure you would use to direct Schwab to wire those funds out to the investment sponsor. You can search this on our website as well. Let me search there right now. So Schwab, I'm going to do a search for Schwab private investment. This is a great search tool on our website. It comes right up. Charles Schwab wire form directive for alternative investments such as real estate, promissory note, and private investment. So let me share this with you here. We'll take a look at this. It's got the procedure and the form directive you would submit to Schwab. But in short, or in review, you as the trustee of the plan will hold on to the investment paperwork. The funds will just show as being sent out from the Schwab brokerage account. Schwab will now report it as a distribution because it's an investment. Schwab is now responsible for reporting on the plan. That type of reporting is handled between us and you as the trustee of the plan. So in this case, it's an investment, therefore it does not trigger any type of Form 1099-R or other reporting to the IRS. It would be just like you invested in a publicly traded stock where it's an investment, so it doesn't trigger any type of distribution or reporting. Okay, let's continue with our presentation here, and we'll come back for some more FAQs here. So back to what we're talking about today. Today's main topic is the $70,000 Roth IRA strategy, which is how to use a mega backdoor Roth self-directed 401k to save $70,000 in Roth IRA funds for the year. And we talked about the contribution limits. We talked about how we're concentrating on tax year 2025, but however, it's not too late to still open a solo 401k plan for 2024 here in 2025, so that you can even do the voluntary after-tax contribution for tax year 2024 and then convert that to a Roth IRA. So so technically you could open a solo 401k plan now for 2024 if you don't have one already, do a $69,000 voluntary after-tax contribution based on your earned self-employment income from 2024, convert that to a Roth IRA. Then you could also do a 2025 voluntary after-tax contribution of $70,000 based on your earned income from self-employment income in 2025. and then convert that to a Roth IRA. So you can pretty much double up. But again, we're going to hone in on the 2025 contribution limits. So we are going to move over to the how the mega backdoor Roth strategy works. This is a great page from our website that talks about it as well. So obviously, you first need to open a self-directed solo 401k with a provider such as my solo 401k financial before you can utilize the mega backdoor Roth strategy. Not all self-directed 401k providers provide a self-directed 401k that allows for the mega backdoor Roth strategy. So make sure you use the right provider. Once you identify the provider, you then open the self-directed 401k. Once that self-directed 401k has been opened, then it's time to not only open up the separate brokerage accounts, but specifically the designated brokerage account to hold those voluntary after-tax funds. That's called the voluntary after-tax solo 401k holding account, aka bank or brokerage account. You then need to make that contribution to that designated voluntary after-tax account. That's step number 2. You can make that by check or by linking your bank account to that bank account for the 401k or brokerage account for the 401k, especially if you use Fidelity for the solo 401k that we offer. Fidelity will provide brokerage accounts known as non-prototype investment only brokerage accounts for the self-directed 401k from my solo 401k financial. You'll be able to link your bank account to that Fidelity brokerage account for making that voluntary after-tax contribution, for example. And then under step number 3, that's where you convert those voluntary after-tax funds to the Roth Solo 401k designated account or to a Roth IRA. So today's presentation, we're talking about how to get $70,000 indirectly to the Roth IRA by utilizing the mega backdoor Roth 401k strategy. So here you would convert the voluntary after-tax solo 401k contribution to a Roth IRA. So if you use a Roth IRA at Fidelity as well, then that can be moved over internally to Fidelity as well. Once that's been done, now you end up with $70,000 in your Roth IRA for the year. Then you need to complete our online conversion form so that we collect the necessary information to issue the Form 1099-R. That also satisfied the IRS requirements of formally completing a form to request that type of conversion. In other words, if your account were to be audited, the IRS is going to ask for a copy of the form directive that was submitted to process those conversions for the year. So even though those funds are moved electronically, we still need to collect that information for the file to show that you in fact did request that conversion for the year, so it's documented. And that's why you complete our online conversion form. It probably takes a minute or so to complete. You do that after you move the funds to the Roth IRA. And then under step 5 is we complete the process. The completion of the mega backdoor Roth strategy is not completed until the Form 1099-R is issued to the government to report that conversion. The Form 1099-R gets issued to the government and a copy to you to report it on your taxes. And that's how the mega backdoor Roth strategy works, by making that voluntary after-tax contribution to the solo 401k specific designated account to hold those voluntary after-tax funds, and then converting them over to the Roth IRA. So that's how you get $70,000 of Roth IRA money indirectly into your Roth IRA by utilizing the mega backdoor Roth strategy. Okay, let's take a look at some other questions here. Thanks for participating as well. Again, please like our video. Please subscribe to our YouTube channel. And again, today's presentation is for educational purposes. We're not providing investment or tax or legal advice on today's webinar. Another question here. I plan to contribute after-tax dollars for 2024 and do a mega backdoor. I will hopefully convert this to a Roth IRA ASAP. However, what happens if I accumulate incidental earnings, small interest of dividend, and after tax before I get it to the Roth? I believe that it's taxable. Is that something that my solo 401k 1099R will help me out with? So yes, for conversions, we will issue the Form 1099R as long as you formally request that Form 1099R. Let me share a page from our website that you'll want to take a look at. So you still have until your business tax return due date plus timely filed extension here in 2025 to open a solo 401k and make your voluntary after-tax contribution for tax year 2024. Once you make that voluntary after-tax solo 401k contribution, if there are any earnings, those earnings, which is typically a very small amount, those would also get converted to that Roth IRA. So let's say you contribute $69,000, which is the overall contribution limit for tax year 2024. And then let's further assume that, let's say $100 accumulates in earnings inside that voluntary after-tax account before you have it converted over to the Roth IRA. Well, you're going to, when you convert that 69,000 plus that $100, so $69,100, that's going to be fully converted to the Roth IRA. So then you're going to go to our forms tab of our website right here, and then you're going to scroll down and you're going to complete the form under after tax to Roth IRA conversion. You'll click on that form there, and you're going to complete this form after you have converted the funds to the Roth IRA so that you know how much you converted. So you'll fill out this form, you'll list the basis converted, which is 69,000. Then you'll list the earnings converted, which is $100 in this example, for a total of 69,100. That is going to prompt us to issue a Form 1099-R. Now, a point of clarification is that even though that contribution is for tax year 2024, and you're allowed to make it here in 2025 by your business tax return due date plus timely filed extension, you're not converting those funds till 2025. So the conversion rules are different than the contribution rules. So the contribution rules allow you to contribute here in 2025 for 2024. However, the conversion rules require that the conversion is reported in the year that the funds are actually converted to the Roth IRA, which means that the Form 1099-R will not get issued till January, February of next year. So in 2026, because the conversion is not happening until 2025. Either way, it's not going to have any impact because A, it's only going to be taxable for $100, and that'll be taxable for 2025. But the $69,000 is not taxable because when you make that contribution, you don't get a tax deduction. And the purpose of the mega backdoor is to get more money into your Roth, whether it's a Roth IRA or a Roth solo 401k indirectly. So it's one of those strategies that you utilize to indirectly get more Roth funds. So it'll be taxable as a 2025 conversion, but only $100 will be taxable. That doesn't mean you're not going to be able to also make a 2025 voluntary after-tax contribution, which you can also do this year based on your self-employment income in 2025. And then you can even convert that here in 2025 as well. So you'll get a Form 1099-R next January, February of 2026 to reflect both conversions, the 2024 amount and the 2025 amount, or you can wait till 2026 to do the conversion of the 2025 contribution. So there's more than one way to skin a cat. Okay, let's see if we have any other questions here. Here's a question here. I see 3 accounts under my Fidelity platform. 2 labeled as non-prototype accounts and 1 listed under retirement accounts as brokerage link. Could you confirm if the brokerage link account is one of the 3 accounts set up under my solo 401k? Additionally, is there a preferred way to designate these accounts for pre-tax, post-tax, and rollover mega backdoor Roth contributions? So I'm going to have someone in our accounts team reach out to you, but also you can designate those brokerage accounts at Fidelity that you open for the self-directed 401k that you have with my solo 401k financial. And let me share information on how to do that. Okay, how to identify your Fidelity brokerage account types. All right, so when those brokerage accounts are opened up at Fidelity, they're all opened up with the zero balance. So then you're going to be able to go in there. You're going to be able to log into your Fidelity brokerage account. And you're going to be able to nickname those brokerage accounts. This page here explains how to name those Fidelity brokerage accounts. It's called nickname. That's how you nickname the brokerage accounts. So for instance, the first brokerage account, which are non-prototype brokerage accounts, you can label that one pre-tax. The second one you can label a Roth, and the third one will be labeled after tax. That way you know which one is which because you're required to segregate each source of funds. Let me share this with you. And again, I'll have someone from our accounts team also reach out to you. There's the link there to this page I'm looking at here. Let me take down your information here. Give me a moment here. Okay, so I'm trying to sure I've got the right spelling here of your name. Okay, I found it here. So we'll be following up with you here this morning. But essentially, you can nickname those Fidelity brokerage accounts. So you should have a total of 3 brokerage accounts if you are the only participant in the plan. And this page here explains how to nickname those brokerage accounts. So this is what it's going to look like once you nickname those holding accounts. It's going to look like this. So the self-employed business sponsors the plan, so it's one plan. 3 separate brokerage accounts if it's a one participant plan. One is titled pre-tax, the second one is Roth, and the third one is the after-tax. That's the voluntary after-tax bucket. If you have a self-employed business where there are 2 participants in the plan, let's say both spouses are participating in the plan, there would be a total of 6 brokerage accounts. 3 different brokerage accounts for each spouse for a total of 6. Now, since we're talking about the mega backdoor Roth and how to get $70,000 into your Roth IRA, If both spouses work in the same business and they both have earned income from self-employment activity, they could each contribute $70,000 to the voluntary after-tax solo 401k bucket, and then they can convert that $70,000 to the Roth solo 401k or to their respective Roth IRAs. So they would each have their own separate Roth IRA, and then they would convert the voluntary after-tax solo 401k contributions to their separate respective Roth IRAs. So that's another way to really supercharge your Roth IRA savings, is by both spouses who work in the same business, and if they have enough net self-employment income each, they could each do that mega backdoor Roth strategy. 70,000 each, convert it to the Roth IRA or to the Roth solo 401k. You get to choose. Okay, let's see here. Another question here. Contribution limits in 2024. I earned 14,000 from my locum tenens work under my solo 401k. I also contributed 20,000 after tax to my employer sponsored 401k and rolled it into a Roth account. Does my employer contribution impact how much I can contribute to the mega backdoor Roth portion of my solo 401k? How much can I allocate pre-tax, post-tax, given my earnings? Well, you first need to identify how your self-employed business is taxed. But to answer your question, voluntary after-tax solo 401k contributions are not impacted by any of your contributions that you make to your daytime job, whether it's employee contributions that you make to your daytime job or employer contributions that you make to your daytime job. That's one of the advantages of voluntary after-tax solo 401k contributions. For example, let's say you work for the Home Depot and you participate in the Home Depot 401k. And for 2024, the overall contribution limit is $69,000. So let's say you contributed the full $69,000 to your Home Depot 401k for 2024. And now you open a solo 401k plan here in 2025 for 2024, or you already have a solo 401k. You can also contribute $69,000 of voluntary after-tax solo 401k contributions to your solo 401k here in 2025 for tax year 2024, and then you can convert that entire 69,000 to the Roth IRA or the Roth solo 401k. So voluntary after-tax solo 401k contributions are not subject to those aggregation contribution rules, in other words. So that's one of the great benefits about the self-directed solo 401k, specifically making voluntary after-tax contributions if we're talking about a 401k. If we're talking about a 403b, then the rules are a little bit different. So if you have a 403b, let us know, because those would get impacted. The voluntary after-tax contributions are impacted if you contribute to a 403b, but not a 401k plan at your daytime employer. So hopefully that answers that part of the question. Now, other contribution types are impacted. Let's say you make an employee contribution to your Amazon daytime employer 401k or Home Depot daytime employer 401k. Those will impact your employee solo 401k contributions, but not the voluntary after-tax contributions. Now, if you make an employer contribution to your daytime 401k, those will not impact your solo 401k employee contributions or the solo 401k employer profit sharing contributions. And of course, not the voluntary after tax solo 401k contributions that we discussed earlier. So hopefully that answers that question. All right, let's see what other questions we have here. Looks like another question here. Regarding the mega backdoor Roth process and tax reporting. When I roll over funds into the mega backdoor Roth, do I need to notify you beforehand? Additionally, will you provide a Form 1099-R for the rollover? And do I need to file before the tax deadline? So we talked about this a little bit earlier already here on this video presentation. But yes, we handle the Form 1099-R for clients who timely requested. So we'll issue that Form 1099-R to the IRS and to the client. Now, if you process a mega backdoor conversion here in 2025, again, that Form 1099-R is not going to get issued till January, February of next year of 2026, because that's how the rules work. So don't confuse the contribution rules with the conversion rules. The contribution rules allow you to contribute to the solo 401k plan for the prior year by the business tax return due date plus timely filed extension. But the conversions, those are always reported in the year that the funds are actually moved to the Roth solo 401k or the Roth IRA. And as I mentioned already earlier in the presentation, it's not a big deal because voluntary after-tax contributions are not going to be taxable anyways when they're converted. It's just a reportable event. Why? Because when you make voluntary after-tax solo 401k contributions, just as the words imply, they're made with after-tax funds. Therefore, you don't get a tax deduction. All right. Well, let's see here. But I also shared earlier the steps involved in the conversion process, which means that, let me see if I can bring that up again here. Maybe you came late to the presentation. Um, so here are the steps involved in the mega backdoor strategy. So once you move those funds from the voluntary after-tax bucket to the Roth IRA or the Roth Solo 401k, then that's when you let us know that you've done the conversion. And you do that by filling out our online conversion form, which is what we collect, which is how we collect the information to issue that Form 1099-R. So here's the Forms tab of our website. And the reason you don't fill out that conversion form until after you've converted the funds is because you don't know how much you've converted till after you've processed the conversion. So that's why you need to fill out the form after the fact. Okay. Let's see here. What else? If we have any other questions here. Follow-up question here. If we do 2 conversions in 1 year, is it okay to submit the form twice, once for each? Or do we need to wait to submit in total? You have 2 options. You can wait to submit the total amount converted during the year. You can submit that form by the end of the year, or you can submit one each time for each amount. The reason being is that only one Form 1099-R is issued to report the cumulative converted amount during the year. So a separate Form 1099-R doesn't get issued for each amount converted during the year. So if you process 2 conversions in 2025, even if part of that conversion contains voluntary after-tax contributions from tax year 2024, it's still going to be just one Form 1099-R to report all the conversions processed in 2025, because again, conversions are reported to the IRS for the year that the funds are actually moved to the Roth account, whether the Roth Solo 401k or the Roth IRA. Therefore, one Form 1099-R, and then you can just submit one online conversion form, or you can submit 2, and then we'll add it up together, and we'll issue the one Form 1099-R. Okay. I think that about does it for today. We'll be back again here at 1 p.m. Pacific time. Again, thanks for joining today's daily webinar where we discussed your live questions here on the webinar. And We also discussed the $70,000 Roth IRA strategy, whereby is how you use a mega backdoor Roth solo 401k to save $70,000 indirectly in your Roth IRA. So again, like our YouTube channel and subscribe to more videos like this. And until 1 p.m. Pacific time, have a great rest of the day.